So let's bring in our next guest. David Kudla is founder and CEO of Mainstay Capital Management. And David, I'm looking at WTI now at $74 a barrel. It's been a kind of a pretty straight line down since about June 3rd or so. As long as oil prices keep coming down, investors are feeling better, aren't they?
Yeah, they are. First, we have this geopolitical risk that we believe with the MOU will diminish. Oil will make its way around the world to restock the global supply chain, so we don't have that, that worst case scenario of a global recession being sparked by this conflict in the Middle East and the Persian Gulf. And so we have essentially, with oil coming down, that also lessens inflation concerns. We heard about some of that yesterday. So this is there's some good news for the markets here, certainly over the past week or so, and we're seeing good rebound again today.
So focus presumably back on some, I guess, more fundamentals like earnings and things like that. How are you thinking about that? How are you kind of charting out the path forward from today?
Yeah, if we look at the two factors that have most impacted the market this week, it's been this development with the Iran war and the MOU, which I believe and many believe the MOU is literally to get oil moving. Even Iranian oil has been sanctioned for years, and we've now heard from Kevin Warsh, the new Fed chair, on how he views inflation, how he views his monetary policy. We don't know what he's going to do or how he's going to do it, but he's made clear there's definitely a hawkish tilt now, and we saw that even in the votes for the FOMC meeting. So we have those two things that are impacting markets. When we come back to earnings, Paul, the earnings are spectacular. The best earnings we've had since the late 90s, 28.8% earnings growth for the first quarter. We expect that double-digit earnings growth to continue. Margins are incredible. So when we look at fundamentals, things look very good for this market. We've had expansion in stocks without any multiple expansion. It's just been that earnings are keeping up with the price that's been shooting up higher and higher.
So if you were to look for value, if you were to look for someplace where the price has not caught up with the valuations, price has not caught up with the fundamentals yet, the earnings picture yet, could you find one in the U.S. market?
You could. I mean, you could go, with the Iran war, there's been concern about industrials that are concerned about anything that's economically sensitive, and that's really the same around the world. So with the risk, that external risk coming off, we've seen risk assets rally just incredibly well over the past week, and we still favor over value, over staples, or over consumer, the consumer defensives or defensive stocks. We still favor the AI trade. We have renewed vigor in our bullishness there, and emerging markets, whether it's Asia, Taiwan and South Korea, where it is part of the AI trade with chip manufacturers and so forth, or commodity producing countries. And so we're really still biased towards growth. Even though growth has come a long way, that's where the earnings are going to be going forward. That's where we want to be.
So, David, you've been in this business a long time. You've seen a lot of IPO cycles, a lot of big companies come to market. When you see the SpaceX IPO, just its sheer size is amazing. And now we've got filings from Anthropic and OpenAI. I mean, again, more mega billion-dollar IPOs. What does that tell you about this market, broadly defined?
I think there's a combination of things, right? There's that we have a good environment for an IPO to come to market. We saw that with SpaceX, probably doing better and continuing to do better than many had thought, doing up 20% on IPO day and now up even higher. The other two are down the road quite a way, but quite a ways. But I think it's a combination of that enthusiasm for the whole AI space and the space, the space, what's happening with SpaceX and the other stocks. So we're in a good IPO environment, and we're with industries that have a lot of future promise. So it's a good environment for these companies to be coming forward. SpaceX has been around a long time, and it's been a good decision to launch that IPO now.
I hear what you're saying. You're clearly feeling good about where things are with the economy, with the market, with valuations. But what are you concerned about? What worries you? What potentially keeps you up at night?
Inflation. That was our biggest worry. We knew we were going to get that print above 4%. We got 4.2%. And with the conflict in the Middle East, we had continuing pressure on inflation. AI, Kevin Warsh has made this argument that down the road, it will reduce costs. And that's really what we've seen with technology since the 1980s. We've had that technological revolution that created a disinflationary environment in the US and other parts of the globe. We're going to see that with AI. But right now, because of the investment, because the energy demand, it's going to be driving inflation. So that's really our concern. That's where we could see some cracks in the market. But boy, if it's about fundamentals, we still are very constructive on stocks.
How about fixed income, David? What's the call there these days?
Yeah, we've stayed away from duration. We made that call in late last year. A lot of people are calling for rates to come down this year. Our forecast was for rates to go up. Now, certainly that's been exacerbated by the Iran war, by what's happened with oil. But we still see a inflationary environment for now, higher rates, not lower rates. And what's happened with the Fed? Let's just use the Fed as an indicator. They came into the year thinking they were going to cut rates sometime this year. Now there's no talk, especially yesterday, no talk about cutting. It's a matter of when they'll raise rates. So, we're still, staying ultra short, not ultra short bonds, but well, we're doing some of that, but ultra short on duration. We don't want the interest rate sensitivity. A little bit of a reprieve here today and this week with developments in Iran and the Middle East, but we're still concerned about bonds. We'd still rather go to a diversified commodity play to diversify the stocks in our portfolio rather than bonds. We just don't think bonds offer that great an opportunity. All right, especially interest rate sensitive.
You might not like duration, but the companies that are issuing debt like a lot of duration. NVIDIA joining the debt issuance parade, selling investment grade debt for the first time in 5 years. How do you think about taking on some of that debt? It's not a credit risk in the same way that the companies adjacent to the AI trade are.
Right. It's high quality debt, or for the most part, higher quality debt. So it is going to be interest rate sensitive. But as far as, the financial engineering, if you want to call it that they're doing, makes total sense. The issue debt, buy stock back, invest. They're doing it all for the right reason. And that debt in terms of default risk, credit quality, it's a good place to be. We're just concerned as we would be with treasuries and high quality bonds that are interest rate sensitive. And we're still a little bit concerned in that area. Although we have with what's happening, if this is really the end of the Iran war, and I even question that, right?
Yeah.
This was about getting oil back on the market, even Iranian oil that's been sanctioned for years.
We got to leave it there. David Kudla is founder and CEO of Mainstay Capital Management.